Hello and welcome to Close of Business. I'm Alicia Barry. A surprise tick up in the unemployment rate has sparked concerns the labour market is weakening. Financial market expectations for an August rate cut have lifted, along with the hopes of a growing number of people who are looking for work. Nasim Kadem reports.
Even on the hunt for casual work, Josh Mann says it's a tougher market to land jobs.
The industries in Australia are all shrinking right now, and the job market is not in a good place from what I understand it.
He was made redundant from a business banking role at CBA in late 2023 and then spent a bit over a year on a contract role with the bank before leaving the corporate sector. He's now training to be a librarian.
Right now I'm just looking for things to make ends meet while I go to TAFE. I've got, looking for construction jobs, stacking shelves.
But it's getting harder to find work. Australia's unemployment rate jumped to 4.3%, its highest since November 2021. A rise of just 2,000 new jobs was offset with a jump in unemployment, with an additional 33,600 people looking for work. Part-time employment grew by 40,000 people, but was cancelled out by a drop in the number of people working full-time.
That is a clear sign, I think, the labour market is weakening, and it's not just due to statistical anomalies.
The more competitive jobs market is happening during a period of greater outsourcing, especially in the finance sector. The Finance Sector Union has singled out the Commonwealth Bank, arguing that out of about 400 local roles made redundant by CBA over the past year, more than 100 were essentially the same or similar to roles filled later by CBA in India.
We're seeing all of the major banks, all four of them, the CBA, Westpac, ANZ and the NAB, all offshoring. And the work that's been offshored is technology roles right through to workers in processing areas, loan documentation, mortgages.
CBA says most of its 13,000-strong technology workforce is based in Australia. It says when roles change, the bank's priority is always to redeploy or skill for a new role wherever possible. It refutes the FSU's claims, which it says have no basis. Dr. Lisa Heap is a labour lawyer and researcher at the Centre for Future Work. She says outsourcing is becoming more common, not just in the finance industry, but across the public and private sector.
I think it creates huge risks, and the risks are not just to the individuals who are losing their jobs. Those skills and capabilities that those people have in Australia are now going to be developed somewhere else. And they're going to be developed in an environment potentially where there's lower labour costs, less safe work practices and the like.
With the labour market showing more signs of weakness, market pricing shows a near certainty the Reserve Bank will cut interest rates next month. Some economists are forecasting at least 4 more rate cuts from the RBA later this year and early next.
Yeah, there you go. It's all good.
Amid all this economic uncertainty, Josh Mann is trying to stay positive. Before he left the bank, he says he trained CBA workers in India and believes that outsourcing and artificial intelligence are going to see more local jobs go.
We had people who'd been with the bank for multiple decades, and that experience was all just lost when they were moved to India.
The silver lining, Josh says, is he has valuable skills that he can apply to new roles.
The jump in the jobless rate comes a week after the RBA shocked markets and held fire on an interest rate cut, sparking criticism from some economists that the RBA is late to the party on rate cuts. I spoke to Zac Gross, Senior Lecturer in Economics at Monash University, about the central bank's approach. Zac Gross, welcome to Close of Business.
Thanks for having me.
Do you think that the RBA got it wrong by not cutting interest rates this month, given what we saw with the job starter?
Look, I think it was certainly a surprising decision, given that they pretty clearly heavily indicated that they knew the direction they were going to be heading, and it was mostly a matter of timing. I think if they were firm on the direction, that is, more cuts were going to be coming, then they probably should have pulled the trigger as it was. And I think the unemployment figures that came out this week have only confirmed that an interest rate cut would be appropriate.
So was it a mistake?
Look, If it was a mistake, it was a very small mistake. At the end of the day, they meet again in August, so only 4 weeks apart. Now, 4 weeks can matter a lot for an individual household on a large mortgage, but for the Australian economy as a whole, it's probably a immeasurable difference. And so if they do follow up and cut interest rates in August, I don't think it will make much of a difference in the broad scheme of things.
So perhaps the jobs data was what they were waiting for?
That was one of two key pieces of data they were waiting for. The first was the jobs data and the unemployment rate. And the second that will come out in the next week or two is the inflation figures, which will give them an updated reading on where inflation is at in the second quarter of the year. So certainly the rise in the unemployment rate is going to be another factor weighing in favour of an interest rate cut. But the inflation numbers will be the next big piece of information that they're waiting to see.
The month-to-month jobs series from the ABS is notoriously volatile. What did you see in the data?
Look, it is volatile. I would say the RBA takes the monthly indicator seriously, but not literally. It does provide some good insight into price pressures in the economy, but ultimately it only covers about 70% of prices in the economy, and so it's really that quarterly number that the RBA hangs its hat on when it comes to determining where inflation is at. So I think the inflation figures are a positive sign that more interest rate easing will be required, but it's certainly not definitive until we see the quarterly figures, and I think that's the decision that the RBA has come to. It's something they've said before, but it's something I think a lot of other economists and market makers perhaps ignored in their enthusiasm to follow the monthly figures, even if they are a bit noisy.
And it's interesting you say the markets really clung to that monthly figure in May. It was essentially dismissed by Michelle Bullock. Without that monthly indicator, presumably markets would be pricing in an August cut.
The monthly figures are still a serious piece of data and should be looked at and considered. But ultimately, there is some substantial error when using, say, 2 months of monthly inflation data to try and predict the overall quarterly outcome. The full set of numbers will be what the RBA is going to be looking for when it comes to making sure they can cut interest rates in August and throughout the rest of the year. And so ultimately, I think that will be the final arbiter about whether they cut in August.
Well, Andrew Lilly, the chief interest rate strategist from Barrenjoey, told the program this week the RBA is right on track. There are other economists like AMP's Diana Messina who says the RBA made a mistake. What do you think about the RBA's performance?
Look, I think broadly speaking, the RBA has done a pretty good job, especially since the end of the pandemic. At the end of the day, inflation is now well back into the target band. The unemployment rate, despite the uptick, is still at a very low level historically and below, I think, at most measures of full employment. And even compared to other countries around the world, we're doing much better than New Zealand, which has seen a sharp rise in its unemployment rate, and better than the US, which is sort of yet to get back to target. So look, it's, you can always quibble about the timing of a cut here or the wording of a statement there, but broadly speaking, I'd say the RBA has done a pretty good job over the past couple of years.
Well, markets are pricing in about an 89% chance that there will be an August rate cut and at least 2 by the end of the year. Should we trust them given they got the July decision so wrong?
Well, look, markets, while can get it wrong, are not completely infallible. They're still probably the best marker we've got. They were very early to predict the uptick in interest rates during the pandemic, when everyone thought we'd be at the zero lower bound forever. Markets started pricing that in well before most economists did, and so I think you'd always be a fool to bet against the market.
And very briefly, what's your outlook for interest rate cuts?
Well, as I said, you've got to take the markets pretty seriously as interest rate forecasters, and they currently predict 2 to 3 more interest rate cuts over the course of the year. And I think that's probably about right. That would get us down to a neutral interest rate, maybe a touch below. And given where we see the strength of the labour market, I think it would be optimistic to expect anything more than that. And so 2 to 3 interest rate cuts is probably what we'll see.
Zac Gross, thank you so much.
Thanks for having me.
This week, the Treasurer Jim Chalmers was confronted with the release of confidential Treasury advice to the federal government. The documents obtained by the ABC add to the case to both raise taxes and cut spending to fix the budget and warn Labor won't meet its housing target. But the Treasurer says he's pretty relaxed about the accidental release. Daniel Ziffer has this exclusive report.
It was the signature pitch of the election campaign.
For 1.2 million homes for Australians.
Last year and in 5 years' time, 1.2 million.
We're building more affordable housing.
But Treasury says it won't happen. The 1.2 million new homes target will not be met.
We need to do more and we need to do better to hit that target in 4 years' time.
Do you still believe the target can be met?
Yes.
The advice is contained in a brief prepared for Treasurer Jim Chalmers and obtained through the Freedom of Information or FOI process. But the Treasury didn't delete a table of contents that gives an insight into big challenges and contentious suggestions.
That sort of thing happens from time to time. I'm pretty relaxed about it, to be honest.
The heading suggests taxes would need to be raised, and the budget needs both additional revenue and spending reductions to make it sustainable.
We do have to get real about raising more tax, and we also have to get real about spending. We have to do both. We can't really avoid the hard choices here.
I don't think it's particularly surprising that the Treasury has highlighted, as I have personally, that we need to do more to make the budget more sustainable.
The advice was written by Treasury and given after Labor's re-election. The Secretary then, Stephen Kennedy, now runs the Prime Minister's department. Treasury realised its mistake and tried to get the ABC to bin the document, but the broadcaster argues the information is in the public interest.
We absolutely need more frank and fearless advice. We need that happening behind the scenes, but wouldn't it be great if we had it in the public domain too?
It helps to promote the conversation ahead of what is a very important round table, and the more those issues, particularly challenging ones like tax reform, are aired prior to the round table, the better it is.
The government is already planning to double the earnings tax on superannuation balances above $3 million. A headline in the Treasury document talks about building on that reform.
What Mr Albanese has to explain to the Australian people is what those higher taxes are.
The detail suggests Treasury favours lower taxes for individuals and companies and changing parts of the indirect tax system of excises, stamp duty and the GST. In housing, the new minister is advised to use migration and the skills system to boost the construction workforce and leverage grants to states and territories to make them build more homes. There's also discussion of money for enabling infrastructure, things like pipes and sewers, which was a $5 billion coalition policy at the recent election.
Tremendous amounts of money are coming in.
The notes also reveal Treasury has modelled the consequences for the Australian economy of a loss of confidence in the US dollar and the independence of its central bank, the Federal Reserve.
The US President is completely unpredictable. We know that his economic decisions are not based on sensible policy advice like we see from our own Treasury, and therefore anything could happen.
Treasury didn't want you to know this information, but what it reveals is a department unafraid of its own boss, giving frank and fearless advice about key economic issues.
Thanks very much.
A document that asks tough questions of the Treasurer and all of us.
The Reserve Bank wants to end bank card surcharges to save Australians more than $1 billion a year. The proposal goes further than demands from the federal government and applies to both credit cards and debit cards. The RBA is also proposing to lower payment fees, which it says will help businesses. Nasim Kadem again.
At this busy cafe, cash is no longer king. Most customers prefer to use tap and go. But that comes with a cost to the business. The manager says about 2 years ago they decided to make customers pay.
As tough as it was, we kind of felt like we just had to pass that on.
Now the RBA wants surcharges banned.
The best thing ever, they should do that, yeah. That'd be awesome, yeah.
We are giving our hard-earned money to the surcharge.
Just at the top.
Back at Michelle's cafe, she says if the ban goes ahead, she may have to raise prices to cover payment fees.
We can't keep wearing all these costs as a business. Everything has gone up. Wages just went up. Sugar, butter, everything's gone up. Bread, when we just keep wearing it.
The Reserve Bank says the proposal will save Australians $1.2 billion a year, about $60 per card user. It will cover both debit and credit cards operating on EFTPOS, Visa and MasterCard networks. Fees charged by card issuers to payment providers like Bank, Square and Tyro and passed on to businesses will be lowered, saving them about $1.2 billion a year. Fees would also be published to help businesses find the best deals.
At the moment, surcharges are not applied equally to smaller and large businesses. Many small businesses pay much more in terms of surcharges as a percentage than larger businesses do, so they shouldn't be left to carry the can.
Experts like Brad Kelly say the bank should shoulder the cost.
There's 47 million debit cards in Australia. We've been sold these products as a cash replacement. We are accessing our cash that's sitting in the bank. This is a bank problem that's being pushed onto small business and consumers.
He estimates that if per transaction a business has to pay an extra 1% or more, the costs will be hefty.
In the case of, say, a cafe, that's going to be somewhere around $40,000 a year from our calculations. For an average sort of small pub, about $140,000 in fees that they are going to have to find now that surcharging has been told to switch off, basically.
The Executive Director of Square Australia says surcharge reforms in the EU and UK led to downward pressure on pricing for small businesses, but he wouldn't say whether the payment provider would lower its fees.
We'll assess, as we do often, whether our fees are fit for purpose for the market, whether they're adhering to regulation, whether they're competitive.
Treasurer Jim Chalmers says the declining use of cash and the rise in electronic payments is seeing more Australians slug with surcharges. The RBA will now consult with businesses and the payments industry. If the card networks don't do what's proposed, the government could introduce new laws that ban surcharges.
So small latte and a baby chino?
Back at this Melbourne cafe, Michelle is worried about how she'll cope.
You can't keep pushing the prices up. We're going to lose business. So whether we lose business because we've raised our prices again because of these fee things, then it's just going to annoy a lot of people.
The changes are expected to come into effect next July.
Thank you.
The US President Donald Trump has revived market concerns about his willingness to interfere with the independent US central bank. This week admitting he had discussed firing Chairman Jerome Powell with the House, but it was not his immediate plan. Donald Trump has also seized on the cost of the $2.5 billion renovation of the US Federal Reserve's headquarters, hinting the price tag amounts to a fireable offence.
It would not do well for Jerome Powell to be fired because we have to think about ultimately what is it that the president wants. And ultimately what the president wants is for interest rates to be lower. Now, one way of achieving that in the short term would be to simply fire the Fed chair and put a sycophant in. But that is not going to lead to a period of low and stable interest rates.
Mr. Trump appointed Mr. Powell to lead the central bank back in 2017, but he's increasingly attacked the chairman for not lowering rates. It was a record close for the Australian share market thanks to some big gains at the end of the week. Both main indices were up by over 2% by Friday, with the All Ords breaking through 9,000. Julia Lee, the head of client coverage Pacific at FTSE Russell, joined me at the end of trade. Julia, strong gains at the end of the week pushed the share market to a record close. What's behind it?
What a great run for the Aussie share market. We have seen the Aussie share market seeing 2 days of record closes. And if we have a look at the key driver, we saw weak job numbers. And you might ask, how's that impacting on the share market? And what it does is it impacts on the view on interest rates. So expectations around lower interest rates has really given the Aussie share market a boost. If we have a look across sectors over the last 52 weeks, the best performing sector though has been tech, up a huge 29%. But if we have a look at financials, technology, or at the industrial sectors, all gaining more than 20%. So overall, the Aussie share market up 8.5% and on a pretty good run.
And I mean, at the end of the week, BHP was a strong performer on account of its quarterly output numbers with record iron ore production. Are we still seeing that rotation into the miners away from financials?
I guess if we have a look at BHP, first of all, the production numbers were great. Not only did we see iron ore, but also copper production was at a record high. And in terms of quarterly production, iron ore, copper, as well as coal doing really well. It wasn't all great news though. If we have a look at the outlook, they are predicting that production next year will be lower in terms of percentage terms. But overall, it was a great result, and we did see BHP shares rising on the back of that. If we have a look at materials though versus the financials, they're both in very different places, and often things in the market move in cycles. If we have a look at BHP, it's down 8.5% in the past year compared to Commonwealth Bank, which is up 35%. So the banks are probably close to the top of their earnings cycle. What we're seeing now is interest rates falling and probably the unemployment rate going up. So it will be more difficult for banks to clock those type of returns. Whereas for the materials, we're seeing China improving from a very low base, and that's a bit of a tailwind for the material space.
As you say, the market is up over 8% year to date. What are the risks that this run-up won't last?
Well, if we have a look at Australia, I mean, low productivity, and if we have a look at GDP per capita, we're probably closer to the worst rather than the best if we're having a look at our peers. But still, the Australian share market record highs. And I guess if we have a look at what's driving the Aussie share market, what we are seeing is the banking space doing super well. If we have a look at valuations though, historically high. Still, Australia looks relatively attractive compared to our peers around the globe, but I think that's about understanding our market structure. Over in the US, the largest sector is the tech space, and that's a huge growth driver. Whereas here in Australia, it's the banks, and they're not as big a driver. So if we have a look at expectations around earnings, we're expecting to see the earnings from Aussie shares up by 5.7% in the past year, with valuations historically stretched. It does mean that this August reporting season is going to be absolutely crucial. We need to see that earnings growth coming through.
Julia Lee, thank you so much.
Thanks, Alicia.
Qantas has taken legal action to prevent the use of personal data of almost 6 million of its customers, which was stolen in a cyber hack earlier this month. The airline has obtained an interim injunction in the New South Wales Supreme Court, but it says it has no evidence that any of the stolen data has been used so far. At the same time, Maurice Blackburn has lodged a compensation claim with the Office of the Australian Information Commissioner on behalf of the millions of customers affected. From traditional Japanese origin to a global sensation, the rise of matcha, fueled by social media, has now brewed a worldwide shortage as producers struggle to keep up with the rising demand. The lovers of this trendy tea could soon be paying more, as Samuel Yang reports.
At this suburban cafe in Sydney's south, a specialty tea is outselling coffee.
When we first opened, some people asking, why is matcha, how it tastes. But now people are just obsessed with it. Hi, how are you today?
Can I get a matcha latte, please?
Yeah.
Alvin Fang sells more than 20,000 matchas a year. That's more than half of her total drink sales.
Some of the customers, once they try the matcha, they're happy to stay with the matcha.
Today I'm going to show you the top 5 matcha brands you should try in 2025.
It's gone viral on social media. Influencers saying it's a cleaner, calmer caffeine hit, providing a source of antioxidants. But the boom is pushing supply chains to the brink.
For the first time in history, we are experiencing a matcha shortage since autumn of last year.
Matcha now makes up over half of Japan's green tea exports, double what it was a decade ago. Even the nation's biggest tea brands are struggling to keep up, including renowned matcha producer Ippodo Tea. A tourism boom is also fueling the shortage. More than 36 million people visited Japan in 2024, including a record 920,000 Australians. Traditionally, matcha is used in Japanese tea ceremonies like this one. Yukino Matsumoto not only conducts these ceremonies, she also runs a wholesale business supplying cafes and restaurants across Australia.
So these two are ceremonial grade, then these two are culinary, like matcha for latte or baking.
She says she's been experiencing severe delays from suppliers since the start of the year.
Information change every day, really. We are in the daily contact with the Japanese suppliers to secure the stock for us, and then started looking for the new suppliers too.
It's not just here in Australia. Demand for matcha has been soaring globally. At the first auction this year in Kyoto, the average price of tencha, the tea leaves used to make matcha, was almost doubled compared to last year, selling at more than 8,000 Japanese yen a kilogram, or about 87 Australian dollars, which is a record. Another big matcha producer, Maruku Koyaman, just announced price hikes of 50 to 60%.
We are all sharing the pain, producers, distributors like us, and the customers. Yep, price gonna go up for sure.
But scaling up isn't that simple.
You need to grow it from a nursery stage to a mature stage, and that takes about 5 years in the field. For matcha, because it's a specialized crop, you need to have shading, increases the chlorophyll content so they're greener and more vivid green in color, and also increases the amino acids content, which gives it the umami flavor.
Professor Tan says weather events have also hit harvests, reducing production by 30%.
We had unseasonal rainfall and also some frost and high temperatures, which affected the matcha production in Japan.
I think we're ready.
Back at Miss Fan's cafe, she says customers will have to pay a little more.
We can expect a little bit price change in the future, but it won't be a very, very big jump.
A global shortage causing a stir.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.